Every single time you deposit money into a savings account, you believe it's safe. You believe it is accounted for. You trust that your capital is locked away, secured by metal, secured by paper, and secured by the law itself. You trust the bank. But what if that number on your screen, the balance you check every morning, is fundamentally a lie? What if the entire modern banking system is built not on secure capital, but on a mathematical illusion? Welcome to The Financial Coin Historian. Here we dissect power, not just fleeting profit. Today, we dissect the banking system's most powerful and insidious secret, the hidden history of fractional reserve banking. It is a trick so effective, so subtle, that it fundamentally changes the value of your labor. It is a trick that legally, silently, and permanently keeps you poor. This is not just dry history. This is the brutal truth about your money, your savings, and your future. This journey begins not in a modern central bank, but with a humble goldsmith in 17th century London. A simple craftsman whose original trade was simply to secure and store wealth for others. Merchants needed a safe place for their gold, a secure chest against thieves and fire. The goldsmith took the deposit, agreeing to keep it absolutely secure. In return, the customer received a simple paper receipt, a simple promise, stating, "I owe the bearer this amount of gold." This paper note, the receipt, was the silent genesis of all modern banking. Soon, merchants realized they didn't need the physical gold for every transaction. They simply traded the receipts. The paper became the money, backed by the implicit understanding that the gold was always in the vault. The shrewd goldsmith watched. He noticed something utterly critical. People rarely claimed their gold all at once. The vault was always full. The true physical money, the gold, was just sitting there, dormant, waiting. And the temptation became overwhelming. The goldsmith faced a choice: keep the gold secure and earn only a tiny storage fee, or use the dormant gold to generate massive, risk-free profit. He made his move. He began lending out a significant portion of the gold he did not actually own. He took interest on every single loan, pocketing pure profit. This loan was backed by a debt, not by his own capital. This was the birth of the Fractional Reserve System, a simple, brilliant, and deeply dishonest mechanism. The goldsmith discovered he could profit not from production, but from a promise. The goldsmith's trick did not stay small. Rulers, governments, and the burgeoning merchant class immediately saw the immense, irresistible potential for power. They realized they could finance massive, costly wars and ambitious state projects they could never afford with physical gold alone. This system was the ultimate solution to the problem of government debt. It allowed the state to borrow and spend far more than it possessed, backed by the phantom money created through fractional lending. The paper notes, suddenly backed by only partial, tiny reserves, funded their ambitions. The Bank of England was one of the early and most sophisticated masters of this deception. It became the first true central bank, formally legalizing the fractional lie. The reserve requirement was set incredibly low, sometimes at 10%, sometimes even less. This means the math is horrifyingly simple. For every £100 deposited, the bank was legally permitted to lend £900. Your initial deposit was used to create 9 times its value in new credit. The government got its war funds. The banks got massive interest revenue. The public got the illusion of more money in circulation, but tragically less actual value. Let's break down the math. The multiplier effect. It is the financial alchemy that fuels our modern world.
You deposit $100. The bank legally reserves $10. They immediately lend the $90 to someone else. That $90 is deposited into a second bank. Bank 2 reserves $9 and lends $81. This continues. $81 becomes $72.90 and so on. Your original $100 has now generated $90 plus $81 plus the subsequent loans. This creates nearly $1,000 of new credit, 10 times the original deposit. Money is truly created from thin air. This is why the system is not about security or stability. It is about credit expansion. It is about the constant, systemic creation of new money in the form of debt. This institutionalized theft ensures that banks profit immensely by charging interest on money they literally invented.
The petrodollar story is intertwined with this. When the gold standard finally died in 1971, the fractional reserve system lost its last physical constraint. The government's ability to create money became total and absolute. The state could now print without any accountability to gold, but only to the public's faith. The government's borrowing needs soared uncontrollably. The banks, through fractional reserves, could always accommodate this need by buying treasury bonds with money they created out of thin air. This established a critical codependence. The government needs the banks to monetize its debt, and the banks need the government to guarantee the value of the fiat money they create. This is the ultimate political weapon. Every dollar created through fractional lending devalues every dollar you already own. This is inflation, the silent and invisible tax levied without consent. It pays the state's bills by secretly stealing wealth from every citizen's pocket. It is the perfect crime. This system ensures that banks profit immensely by charging interest on money they invented. You, the worker, get paid devalued dollars for your hard work. This institutionalized arrangement ensures that the debt-based money flows to the financial elite first, allowing them to buy assets before prices rise. This system creates inevitable debt cycles, boom and bust. The loans drive the unsustainable boom. The lack of real reserves drives the inevitable bust. The moment trust falters, the entire system can collapse. This is the true historical pattern of every bank run from the 17th century to 2008.
The simple math of fractional reserve banking demonstrates that credit and debt are two sides of the same coin, and that coin is always minted by the bank. The money created by the multiplier effect does not enter the economy equally. This is perpetuated by the Cantillon effect, which is the single most important concept to understanding why you feel perpetually behind. When new money is printed, quantitative easing, bailouts, it flows first to the financial elite, the primary dealer banks, large asset owners, and speculators. They acquire assets, real estate, stocks, land, at yesterday's prices, benefiting instantly before the new money has inflated the market. They receive the wealth. By the time that money trickles down to ordinary citizens as wages or meager loan opportunities, inflation has already soared. The middle class is left to absorb the rising cost of living, having to pay tomorrow's prices for yesterday's assets. You receive the inflation, they receive the wealth. The petrodollar simply magnified this effect globally. Because the world needed dollars to buy oil, the U.S. was guaranteed cheap debt, allowing it to continue financing its deficits through fractional reserves and Cantillon effect transfers.
This system is why your savings always lose value. Fractional reserve banking is the engine of systemic poverty. It ensures that your savings are perpetually taxed by inflation to finance the state's debts and the elite's assets. Rome ran this financial experiment first.
The collapse of the silver denarius was simply the earliest full-scale example, the blueprint for every inflationary disaster since. The debasement of the silver coin is the same financial trick as the modern fractional creation of digital money. The corruption that shattered the silver denarius is the same corruption currently eroding your dollar, your savings, and your faith in the future. Rome ran out of belief, not money.
The system is designed to trap you, but you can defend your wealth. First defense, hold what is real. Not paper promises, but tangible assets, gold, silver, and productive land, assets that cannot be fractionally multiplied or printed away. Second defense, cultivate real skill. The survivors of history were not the bankers, but the producers. Be the person the community needs, the craftsman who can repair tools, the farmer who can feed a community. Third defense, trust yourself. Financial freedom starts not with chasing numbers, but with understanding the structural patterns of power and debt that are designed to extract wealth. The choice is yours. Be crushed by history or learn from its clearest warnings and prepare. Hit subscribe to the Financial Coin Historian to decode the failures of empires and secure your financial future.